Tom, let me start with you and ask whether or not this action this week is sort of a disincentive to own equities, as Mohammed Al-Arian just suggested there on that tape.
Yeah, I don't think it's a disincentive. Nobody likes a roller coaster ride, but the longer your time horizon, the more you're going to benefit from this. So I would be careful not to try to wait for it to stabilize or try to time the bottom. I think we see just on the intraday moves, it's pretty unpredictable. So look at the long-term opportunity. We're pretty attractive valuations here. Take advantage of that and stay in the market or get in the market.
How much risk are you putting on a further downside move, given what you just said?
Well, like I said, there's always risk of a further downside move, and I think investors, to their own detriment, always wait for the stabilization. Think back to the depths of the crisis in 2009. When the market was down at 666, there were bond experts calling for it to go to 400. And then as it moved up, people stayed out of the market waiting for that correction that never came. So I would not focus on what the near-term risks are, but really focus on the long-term opportunity.
Paul, what are the questions that you're getting from clients right now, and how are you advising them?
The main question we get from clients is, given that we see upsides of markets next year, should they be putting new money to work now? We think the answer is definitely yes, and we would look past the question of, gee, where's the bottom here? We think the direction will be up. You need to be putting money to work, do it incrementally, and just be aware that on the way back up again, those resistance levels are going to be pretty significant, we think. It's going to take some time. You need to be patient. So put cash to work and be patient here.
What do you like right now?
Well, we still like cyclicals. We like industrials and consumer discretionary. We also went favorable on tech around the middle of this correction here. We think the values are compelling, and we look for 13% plus earnings growth in tech next year. We also like financials and healthcare.
Tom, obviously we're kind of painting a picture here where the market is potentially overshot to the downside and maybe is not necessarily reflecting some of the economic fundamentals. But what in particular would you be watching in terms of the incoming data, in terms of the credit markets, whatever, to reevaluate that idea and maybe that the markets are kind of foreshadowing something worse?
Yeah, well, if you look at the current economic data, it's interesting because people always talk about a Goldilocks scenario. A Goldilocks scenario is low inflation, low unemployment, moderate to strong earnings growth, moderate to strong economic growth, which we have. We actually have a Goldilocks scenario. I think the thing to worry about, and people look at, is outside the U.S., to look at China. Does China have the ability to stimulate their economy to keep things on track? Now, and also to put it in perspective, revenues from China, from the S&P 500, it's a little over 5%. So it's real, but I think the whole trade issue, it can get overblown, but also you can surprise on the upside on trade as well if we can reach some kind of agreement with China.